I know we talked about the manufacturing specifically, but this is going to break things out into its components because the number was a fairly sizable miss and a pretty big step back from March. Now, not to say that it wasn't going to happen because as we said in March, that was going to be the high and it was going to start to come down. But what is driving that, I think, is the most important thing. So manufacturing companies keep struggling to meet increasing demand with record long lead times, wide-scale shortages of critical basic materials, rising commodity prices, and difficulties in transporting products, according to the ISM report. Recent record long lead times, wide-scale shortages of the worker absenteeism, short-term shutdowns due to part shortages, and difficulties in filling open positions continue to be issues that limit manufacturing growth potential. The current electronics semiconductor shortage is having tremendous impacts on lead times and pricing. Additionally, there appears to be general inflation of prices across most, if not all, supply chains. Now, this is an underlying problem that I think isn't appreciated or missed a bit. Technology, electronics, and semiconductors has been deflationary for years. Computers' capacity has exponentially grown, speed has exponentially grown, and prices have either come down or stayed the same. And now we're at this flatlining point where now it's starting to get more expensive. And that's where we look at the chart and we look at manufacturing at a glance in terms of what they have. And when you look at a lot of these things are slowing. So the rate of change is the one that we want to look at because the things that are positive contributors to the number are slowing. And then the pieces that are negatively contributing to the number are speeding up. So what does that mean? So new orders slowed, production slowed, employment slowed, supplier deliveries about the same slowed. Now that's better. You want that to get a little bit better. Inventory contracting is a positive. It means that you're selling stuff through, you're getting comfortable with it. But customer inventories are, when you look at the movement, it continues to be a movement down. So you have customers that are going to need to buy, but prices are moving faster. So they increased, backlog of orders increased, new export orders increased, imports, it slowed. So when you look at the imports are slowing, backlog is struggling. And this is why we keep saying that prices are going to continue to go up because customer inventory is too low and they're going to essentially buy at almost any price to move some of this additional through the system, which is going to be a net negative. So then when we look at the supply demand imbalance and when you look at that pushing the inputs, so PPI final demand remains elevated at that 4.3. Consumer price index at that 2.6, but ISM price index at 89.6. So when you normalize it on the chart, you can see that the CPI is naturally going to continue to drift higher towards those levels. So that's why it's going to move in the wrong direction of what the consumer can really tolerate. So then when we look at orders, production, employment, they settle at different levels. So the inventories are rolling, but you can see they're all moving in the wrong direction. So delivery time is getting a little bit better, and then based on what we're seeing, as we talked about in the EIA show, not improving all that much. So we're going to stay sideways. Then you look at new orders are starting to come down a bit, and that's in line with some of those backlogs. But the employment is going to be the one to watch, which continues to be some of the bigger issues, especially on wages. And then high backlogs, low customer inventories. That's why when you look at those factory gains, you're going to have they're going to try to close that gap. And you can see how long they can last when you look at 17, 18, and 19. The difference now is there's a lot of supply chain involved, and you do have growth because economies are coming back and getting better. But you're seeing some of that, again, that kind of natural slowdown here where you're just going to see some of this go sideways as it works its way through, but it's not going away anytime soon. Which is why when you look at just the customer inventories, it's a new historic low, which is why these price increases are going to continue to get pushed through. And it's going to be hard for the consumer to say no. And that's where I agree at some point the customer is going to say, I can't tolerate this higher price. but there's not a lot of inventory to backstop that. And that's where the friction point is going to come into, well, how normal are we going to get? And how much of that is going to be eaten through by the company versus passed all the way through. So then when we look at the market news, this Chicago Business Barometer, the Chicago Business Barometer produced rose to 72.1 in April, which is the highest level since December of '83. So clearly, we're again seeing that strength continue through the system. But order backlogs again soared 16.2 points, the highest since 1973. Inventories fell 8.7 points, dipping below the 50 mark for the first time since December. Employment edged higher, 1.7 points to the highest since 2018. Supplier deliveries eased 3.5 points. Prices paid at the factory gate skyrocketed further 11.1 points in April, surging to a 41-year high. Raw material shortages and transportation problems continue to weigh on companies' cost burdens. So positive, but again, the inflationary pressures remain behind it and are going to continue to influence that capacity. And while all of this is happening, you have to look at the U.S. broad labor market recovery. Because when you look at that recovery level, the wage growth, long-term unemployment, initial claims, when you look at March 2021, the wage growth is the one that continues, and that long-term unemployment still remains that big overhang for the comfort in terms of spending and getting back to some sort of normalcy. Now, that remains in the system, but there's some bright spots. So when we talk about small business wage data increased a bit to, it's up 2.84% over the last 12 months. But it's slowing. So we had that nice spike, but now in April, we're starting to see some of that move lower. And April was a strong month. So just consider that April was a strong month for ADP. We'll have to wait for non-farm. But you would have hoped to see a little bit more follow through given the shortages, given the difficulties that we keep hearing about. But the weekly hours rolled over a bit, weekly earnings, hourly earnings, they're not continuing in a comfortable place, and we'd like to see that accelerate, especially given some of the underlying data and the inflation that remains in the system. But when we look at the jobs index, it's gotten much better. So we're essentially back to where we were pre-COVID, but you can see the slowdowns that really took hold in 17 and accelerated through 19, which is why, as we keep talking about, we were already bearish in 19, COVID hit, so here we are. But the acceleration to the downside still remains problematic, and now it's just based on the previous chart, it's going to be hard to close that gap and see some of that acceleration. But then when we look at corporate profits divided by employee compensation, you can see that we had a nice recovery, a rebound as the trend went back up through the end of the 80s. But now we're moving back in that negative trend, speaking to the zombie companies and the pressures at the company level as they're sitting on such an elevated amount of debt. That, again, is some of those shortfalls that continue to persist in the system. And then the cost index. So let's look at employment cost index. So compensation costs for civilian workers increased 0.9% seasonally adjusted for the 3-month period ending in March 2021. Wages and salaries increased 1%, and benefit costs increased 0.6% from December. So when you look at the 3-month percent change seasonally adjusted in terms of comp has gotten better, as it should, given some of the shortfalls, but the wages and salaries and benefits are essentially kind of flatline. When you look at the 12-month percent change, not seasonally adjusted, we're just not seeing, again, that pivot that you would expect given what we see in the underlying data points, which speaks to companies being particular on who they're hiring, as well as what are people willing to accept. So consumer spending, you obviously had that strong number that came through based on what happened in March, and it was again driven by the non-durable goods and durable goods as services started to close some of that gap. Now we think services will accelerate and some of the durable, non-durable goods will start to slow down as we see services taking some of that residual. And the reason why is because the Conference Board Consumer Confidence Income. Now this is looking at at the higher income level versus in general is getting a bit stronger. So we're seeing some of this improvement in terms of what the consumer is willing to spend. Again, it's mitigated by other factors that we've highlighted, but this is still a net positive for where spending can go. Now, U.S. firms are putting their money where the work is, which is spending on software and tech spending. So there's less and less spending on structures versus spending on software and tech. So U.S. businesses have been spending more on technology than on bricks and mortar for more than a decade now, but the trend accelerated. So we're starting to see that acceleration because work from home, flex schedules. As spending on home building has risen, spending on non-residential construction has dropped. With that on commercial and manufacturing office space slumping to under 15% of total construction outlays in March. Business spending on structures fell in the first quarter, but it was the sixth straight quarterly decline, showcasing one of the few weak spots in the economy. And it's just, this is, I think, highlighting just how sticky some of this work from home capacity, flexible schedule will remain in the system because you need software and tech to do it, which is being where the money is being put to work. Now, business expectations, sales and revenue growth. When you're looking at sales and revenue growth, again, we have that reopening, we have the movement, we have a lot of these benefits coming through in general where you're getting some of this acceleration. And then when we look at the employment growth, just looking at the expectations, we're expecting to get more employment. The problem is we're getting the expectations of it, but we're not seeing it, or it's missing the estimates that we're kind of expecting, which again is kind of that friction point. Now, Americans saying that their financial situation is excellent or good, remaining at a strong number of 57%, which again is a positive for some of that consumption, especially on the services side. But when we break it down based on their current and future personal financial positivity, you have to look at who. So household income, 100,000 or more, 74%, where anything below that is still below 50%, where you have 43% and 25%. Now, the ages don't matter as much, but the bigger issue is going to be household income. Those with 100,000 or more feel great about their current situation. And those who are below 100,000 feel much worse versus 2019 and actually still fairly close to where they were in 2020. Less than 40,000 feels a little bit better than 2019, but they've also received how many trillions of dollars in stimulus, which equates to a couple $1,000, but that's enough to change the way that they view the world. But the biggest driver remains the richest components of the U.S. So taking that to the next level, let's look at U.S. consumer spending. This is where we think that you're going to get some of these shifts where goods will start to roll over and services will come up. Not to say that goods are going to come to zero, but you're going to start to see some of this close the gap a bit and still stay fairly strong as the consumer continues to be one of the brighter spots of the U.S. economy. But the U.S. business investment remains against the structured side and really driven towards that equipment and intellectual property when we start talking about flexible schedules, IP, things that are going online. And this is where you're continuing to see that shift. Now, if you think about the building, again, speaking to the building side, commercial manufacturing and office as a share of total, this is where we continue to see this moving down, and it's just unlikely to see this really accelerate back to the highs. So then when we look at Case-Shiller and going to the home side, because if you're staying at home, people want nicer homes, bigger homes, offices. Home prices continue to rip to the upside. And this is just looking at the Case-Shiller home prices year over year, month over month, trending in this upward trajectory, which again will result in higher rentals when you think about rent prices and how this feeds through the system. So then when you look at making up for lost inventory, home builders account for biggest share of single family home listings on record. So home builders are building as fast as they can. But now so the U.S. is seeking a stay on eviction moratorium ruling. So the U.S. judges ruled that the CDC extended its bounds and that the eviction moratorium is actually not allowed. And this is going to be how much new volume comes to market if this is allowed to stay, because that means that you can start going through evictions and foreclosures. So home buyers getting frustrated with bidding wars, so they're turning to new construction. And given the surge in demand, home builders produced roughly 25% of single-family homes listings in Q1, which is the largest share on record. Now, when you look at financing and inflation, this is looking at the ratio of loans to deposits. And this speaks to the banks, because banks just still haven't issued loans. They're getting more deposits. The deposits are coming in, but they're not turning around and issuing loans. And what does that mean? So there was just a headline that came out, and I saved it so I could quote it. The biggest concern now is the Fed's fixed rate reverse repo. So this is the overnight rate, and 162.8 billion is going into the Fed fixed reverse repo, and that should be going into the market in different capacity, and it's just not. And this is just the banks that are feeling a little unsure, sitting on a lot of cash, and are trying to put it somewhere, and they're utilizing the Fed instead of going out there and making loans. As that starts to revert, that's velocity of money. That's going to push more through the system, and we're going to see more of this come through, and that core PCE is going to continue to push higher. Again, all of this leads to just more inflation in general as we see things progressing. So then when we go through the purchase applications index readjusted by PM, and then pending home sales, you're seeing some of this slowdown. But again, there's a lot of seasonality. Some of this is going to continue to go up. The question will be what happens with rates in general. And then just rounding it out with total initial claims. Initial claims have gotten a little bit better. They continue to move in the trajectory, but as we said on Friday, we continue to see this elevated amount that are sitting in the pandemic and receiving some form of support, still sitting at about 16.6 million people, speaking to that, again, that bifurcation of rich versus poor and some of those overhangs on, what do people feel confident about doing in the market in general. So that wraps up the U.S. and globe. And now in the next segment, we're going to turn to Europe. And then in the last segment, turn to Asia to discuss things on a bit more of a broader schedule.